ये हमारा बीकॉम का एक फाइनेंशियल अकाउंटिंग वाला उसका कोर्स का नंबर क्या है?
सर अभी उसका देखेंगे, अभी शायद कुछ टीचर्स ने सोच रहे किसी स्टडी सेंटर से करना।
अच्छा,
क्योंकि उसमें कोर्स कोड फर्स्ट ईयर सेकंड ईयर दोनों के हो रहे हैं। हमारा बैंक ने वो नहीं स्टडी सेंटर ही करा सकता, सोच रहे किसी स्टडी सेंटर से करना।
तो भी हो सकता है कि ना भी, तो बता देना।
हाँ सर, मैं आपको जैसे चालू
क्योंकि हमें आँख का ऑपरेशन करा डालेंगे।
नहीं बता दो सर, जैसे मेरे को वो हो जाएगा ना कि हाँ भाई नहीं हो रहा या हो रहा है, मैं आपको इन्फॉर्म। ये लेफ्ट राइट पर, ये लेफ्ट पर या दोनों पर?
लेफ्ट। हाँ, राइट वाली जो है वो तो एक पहले हो चुका है। लेफ्ट का तो बहुत तकलीफ हो रही, ये बनाने में बहुत तकलीफ हो रही है। हमें तो लगता है कि इसको भी हमें बीच में रखना पड़ेगा।
सर पहले ये ठीक है, तो मैनेज कर ले,
मना होगा तो फिर बताएंगे।
कोई दिक्कत नहीं,
तो इसलिए वो भी बताओ। गुड मॉर्निंग। फाइनेंसिंग ऑफ वर्किंग कैपिटल। First of all, creation of value through working capital management. Creation of value has been said to be the objective of a company. For that purpose, every business is formed. Value maximization is considered consistent with the interest of various groups that interact with the business. How should one proceed to create value through working capital management? The answer is invest in an asset if its net present value is positive. What is net present value? The general formula for finding net present value of a project is net present value is equal to A1 upon 1 plus K raised to 1 and so on. A2 upon 1 plus K raised to 2, so on up to an 1 plus K raised to n minus C. Here A1 to an represent annual cash inflows on an after-tax basis. A1 for the first year, A2 for the second year, A3 for the third year, and so on, An for the nth year. A is the discount factor, which is in practice the cost of capital. C represents the initial outflow. If the summation of A1 upon 1 plus K raised to 1 so on up to An upon 1 plus K raised to n is the present value of inflows and C is the initial outflow. If the difference of inflow over outflow is the net present value. If this net present value is positive, only then the investment should be done. This equation can be used to decide the choice of investment in current assets, taking into account their shorter lifespan. Accepting 1 year life as standard to categorize assets into fixed and current, NPV has to be calculated for each year. For this, the above equation can be modified as follows. to elicit NPV. NPV equal to A1 upon K plus A2 upon K and so on up to AN upon K. And from the summation of this, we have to deduct C. Sometimes practitioners tend to use net profit criteria to decide the investment in current assets, which they consider is a simple modification of the concept of NPV as shown below. Net profit per period, we may say NOT, equal to NPV multiplied by R 1 minus 1 plus R raised to N. Or you may say this is the formula for compound interest. While the above sounds logical theoretically, in practice, firms are choosing innovative approaches to create value through current assets management. For instance, firms are very active in commodity markets to buy raw materials while they are in full supply. They are not minding the size and cost of investment in these assets. More so, firms are also adopting risk management techniques like options, hedging, etc. Like any usual trader in the stock market, they are watchful of the trends in both stock and commodity markets. Similarly, ideal cash is now intelligently invested in various markets such as money market, mutual funds, and finally, equities. Many current assets decisions, particularly inventory decisions, can be made on the basis of minimizing cost. They are also, instead of minimizing the net present value of cost, one may minimize total annual cost, where the annual capital cost of the investment is the discount rate times the amount invested. Approaches to working capital investment. Every business enterprise needs to pay particular attention toward the planning and control of working capital. Different approaches have been suggested for this purpose. Of them, let us focus our attention on the following two approaches. Walker's approach and trade-off approach. Walker's approach. Walker has laid down that a firm's profitability is determined in part by the way its working capital is managed. When the working capital is buried relative to sales without a corresponding change in production, the profit position is affected. If the flow of funds created by the movement of working capital is interrupted, the turnover of working capital is decreased, as is the rate of return on investment. In this regard, Walker has laid down the following four principles with respect to working capital investment. If working capital is varied relative to sales, the amount of risk that a firm assumes is also varied and the opportunity for gain or loss is increased. This implies that a definite relation exists between the degree of risk that management assumes and the rate of return. The more the risk that a firm assumes, the greater is the opportunity for gain or loss. Capital should be invested in each component of working capital as long as the equity position of the firm increases. This principle is based on the concept that each rupee invested in fixed or working capital should contribute to the net worth of the firm. The type of capital used to finance working capital directly affects the amount of risk that a firm assumes, as well as the opportunity for gain or loss and cost of capital. It is indisputable that different types of capital possesses varying degrees of risk. The greater the disparity between the maturities of a firm's short-term debt instruments and its flow of internally generated funds, the greater the risk, and vice versa. Now the second approach, trade-off approach. It is evident from the study of Walker's principle that working capital decisions involve a trade-off between risk and return. All decisions of the financial manager are assumed to be geared to maximize shareholders' wealth. And working capital decisions are no exception. Accordingly, risk-return trade-off characterizes each of the working capital decisions. There are two types of risk inherent in working capital management: liquidity risk and risk of opportunity loss. Liquidity risk is the non-availability of cash to pay liability that falls due. And opportunity loss risk is the risk of not being able to produce more or sell more or both because there are not enough funds to support higher inventory and book debts. If, for example, if cash is short, the cash is not available in the required quantity, then there will be opportunity loss. And if cash is in surplus and that is invested in some short-term securities, then it will be at the time of, if a liability becomes due, then the payment will not be possible. Financing the firm's working capital requirements, we are now talking of approach to financing working capital. Financing the firm's working capital requirements has been shown to involve simultaneous and interrelated decisions regarding the firm's investment in current assets. Fortunately, there exists a principle which can be used as a guide to firms' working capital financing decisions. This is the hedging principle or matching principle. Simply speaking, the hedging principle involves matching the cash flow generating characteristics of an asset with the maturity of the source of financing used to finance its acquisition. For example, a seasonal expansion in inventories, according to the hedging principle, should be financed with a short-term loan or current liability. The rationale underlying the rule is straightforward. Funds are needed for a limited period of time, and when that time has passed, the cash needed to repay the loan will be generated by the sale of the extra inventory items. Means, in short, the hedging principle states that the firm's assets not financed by spontaneous sources should be financed in accordance with the rule. Permanent assets, which also includes permanent working capital, financed with long-term sources, and temporary assets, that is, fluctuating working capital need with short-term sources of finance towards the liquidity risk. This has been illustrated in the following figure. The figure depicts the hedging financing strategy. Here you will see that fixed assets and permanent current assets, both these two are financed from the long-term finance, while temporary current assets are financed by short-term finance. And temporary current assets, sometimes they will increase, sometimes they will come even to zero, and so on. The amount will be used from short-term financing only when it is needed. After that, the amount will be generated from the inflows and the loans, etc., will be repaid. Effect of choice of finance on ROI, return on investment. Here I have given you two balance sheets of firm X and firm Y, and as well as two income statements of firm X and Y. In the balance sheet, current assets is same for both the firms, 40,000. Fixed assets is also same for the firms, 80,000. Or total assets is same, 1,20,000. Accounts payable, in the, you may say sundry creditors or bills payable, etc. They are same for both the firms, 10,000. Bank credit is only in case of firm Y, 30,000. While long-term debt only in case of firm X, 30,000. But as the bank credit is part of current liabilities for firm Y is 40,000, while the current liability for firm X is 10,000. But equity for both the firms are same, 80,000. And total liability is same, 1,20,000. Now the income statements. Net operating income which we may say EBIT. For both the firms, 64,800. Interest in case of firm X, 16% of 30,000, 4,800. And in case of firm Y, 10% of 30,000, 3,000. Therefore, total income for firm X is 60,000 and for firm Y is 61,800. Profit after tax, net income, if the taxation rate is 50%, is 30,000 in case of firm X and 30,900 in case of firm Y. Current ratio. In case of firm X, current assets are 40,000 while current liabilities are 10,000. Therefore, ratio is 4:1. But in case of firm Y, current assets are 40,000 and current liabilities are also 40,000. Therefore, ratio is 1:1. In case of firm Y, there is no net working capital because both current assets and current liabilities are 40,000 each. While in case of firm X, it is 40,000 minus 10,000. That is current assets minus current liabilities, 30,000. ROI in case of firm X, 37.5%. Or you may say 30,000 divided by 80,000. And in the same way, in case of firm Y, 30,900 divided by 80,000, it is 38.6. Earning per share is rupees 3 in case of firm X and rupees 3.09 in case of firm Y. Thus, if firm can reduce its risk of illiquidity through the use of long-term debt at the expense of a reduction of its return on investment. See in case of firm X. Current ratio is 4:1, better than firm Y. But ROI is less than firm Y. In case of firm X, it is 37.5%. While in case of firm Y, it is 38.6%. Once again, we see that the risk-return trade-off involves an increased risk of illiquidity versus increased profitability. Now, the next topic, payables management. A substantial part of purchase of goods and services in business are on credit terms rather than against cash payment. While the supplier of goods and services tend to perceive credit as a lever for enhancing sales or as a form of non-price instrument of competition. The buyer tends to look upon it as a loaning of goods or inventory. Payables constitute a current or short-term liability representing the buyer's obligation to pay a certain amount on a date in the near future for value of goods or services received. They are short-term deferments of cash payments that the buyer of goods and services is allowed by the seller. Trade credit is extended in connection with goods purchased for resale or for processing and resale, and hence excludes consumer credit provided to individuals for purchasing goods for ultimate use, and installment credit provided for purchase of equipment for production purposes. Trade credits or payables could be of three types: open account or open credit operates as an informal arrangement wherein the supplier, after satisfying himself about the credit worthiness of the buyer, dispatches the goods as required by the buyer and sends the invoice with particulars of quantity dispatched, the rate and total price payable, and the payment terms. The buyer records his liability to the supplier in the books of accounts, and this is shown as payables on open account. The buyer is then expected to meet his obligation on the due date. In contrast to open account or open credit, the promissory note is a formal document, while open account or open credit was informal arrangement. The promissory note is a formal document signed by the buyer, promising to pay the amount to the seller at a fixed or determinable future time. Where the client fails to meet his obligation as per open credit on the due date, the supplier may require a formal acknowledgement of debt and a commitment of payment by a fixed date. The promissory note is thus an instrument of acknowledgement of debt and a promise to pay. The supplier may even stipulate an interest payment for the delay involved in payment. Bills payable or commercial drafts are instruments drawn by the seller and accepted by the buyer for payment on the expiry of a specified duration. In case of promissory notes, just we have discussed, it was written by the buyer. Here, bills payable or drafts are done by the seller, only accepted by the buyer. The bill or draft will indicate the banker to whom the amount is to be paid on the due date, and the goods will be delivered to the buyer against acceptance of the seller. The seller may either retain the bill and present it for payment on the due date, or may raise funds immediately thereon by discounting it with the bank. The buyer will then pay the amount of the bill to the banker on the due date. Determination of trade credits. Size of the firm. If the size of the firm is large, the trade credit can be easily obtained. But if the size of the firm is small, the trade credit will be difficult. industrial categories. In some industries, trade credit is normal. Means if a new company enters into the same category, they will have to give the trade credit. Otherwise, they will not get any customer. Rather, you may say they will have to give more trade credit, cheaper trade credit, so that they may attract buyers. Nature of product. If the product is perishable, the trade credit will be normally more, because the seller is not in a position to hold the product. It is to be sold immediately. Financial position of seller. If the seller has got good financial position, he will be in a position to give more credit to the buyers, because he has got sufficient financial strength to give credit to the buyer. But if the financial position of seller is tight, he will like that the buyer may pay cash against delivery, or sometimes even cash before the delivery. Financial position of the buyer. If the financial position of the buyer is strong, seller will not mind giving him larger credit. But if the financial position of buyer is not strong, seller will hesitate to give goods on the credit. Terms of sale. If the terms of sale is only cash, then there is no question of trade credit. If the goods are sold on credit, then certainly there will be trade credit. Cash discount. If credit is given, say, for a long period, say for 60 days, seller will like that the sum amount is collected as early as possible. He may give some cash discount, which may vary according to the date of collection. Degree of risk. If the seller is in a position to take more risk, there will be larger amount of trade credit. Otherwise, there will be a shorter amount or very less trade credit. Nature and extent of competition. If there is a large competition, so many sellers are there, then credit will be allowed more. If there is monopoly, then there will be no trade. And datings which are normally allowed in the agricultural sector. Now, cost of credit. Trade credit is a built-in source of financing that is normally linked to the production cycle of the purchasing firm. If payments are made strictly in accordance with credit terms, trade credit can be regarded as a cost-free, non-discretionary source of financing. We have already discussed it. But where the buyer takes the privilege of delaying payment beyond the due date, it assumes the form of discretionary financing And if this becomes a regular feature, resulting in delinquency, trade credit will cease to be costly. The supplier may stop credit or may charge a higher price for the product to cover the risk. The supplier may offer cash discount for payment within a specified number of days after the invoice or after the receipt of goods. Generally, such concessions for expedited settlement are given to select customers on informal basis, where the aim is to induce earlier payment wherever possible. Cash discounts are provided for in the credit terms. The quantum of discount offered will vary for different categories of business and clients. Cash discount is to be distinguished from the other categories of discount that may be offered by the seller, namely the trade discount and the quantity discount. The trade discount is a reduction from the invoice or list price offered to the dealer or trader in the channel of distribution. Quantity discounts are given when purchases are made in sizable lots. When the cash discount is allowed for payment within a specified period, we can compute the cost of credit. I have given 3 examples. If 30 days credit is offered with the stipulation of a 2% cash discount for within 10 days, it means that the cost of deferring payment by 20 days is 2%. If payment is made 20 days earlier than the due date, 2% of the amount due can be saved, which amounts to an attractive annual saving rate of 36%. Here, I have assumed year to be of 360 days. Therefore, for 20 days it is 2%, and for 360 days it becomes 36%. If cash discount is not availed, the effective rate of interest of the funds held will work out to be 36.7%, which is the interest is rupees 2 on rupees 98, 100 minus 2, for a period of 20 days. And the rate of interest will be simple formula of interest. 2 is the interest divided by principal amount 98. Year is taken off, being assumed to be 360 days divided by 20, that is 36.7%. If 60 days credit is extended in place of 30 days credit with the same cash discount of 2% for payment within 10 days, there will be a saving of rupees 2 in place of 20 days for paying 50 days ahead. And the effective rate of interest is now 14.7%. Same calculation. 2 by 98 multiplied by 360 by 50. And if in case of 30 or 60 days, 90 days is credit with 2% this cash discount for payment within 10 days, the effective interest rate works out to 9.2%. In the same way, the calculation has been done. Here you will see that as the credit is extended, the effective rate of interest is decreasing. Thus, the more liberal the credit terms, the saving from cash discount declines, and so does the effective rate of interest for using the funds till the due date. If, however, the discounts are not taken and the settlement is made earlier than the due date, the effective rate of interest will vary. For a firm that resists from taking the cash discounts, its cost of trade credit declines the longer it is able to delay payment. But at the same time, the buyer may lose trade credit for the next transaction. Chances are there. The rationale for availing trade credit should be its savings in cost over the forms of short-term financing, its flexibility and convenience. Stretching trade credit or accounts payable results in two types of cost to the buyer. One is the cost of cash discount foregone, and the other is the consequence of a poor credit rating. The contention that there is no explicit cost to trade credit if the payment is made during the discount period, or if the payment is made on the due date when no cash discount is offered, is not totally tenable. The supplier who is denied the use of funds during the credit period may bear the cost fully or pass on part of it to the buyer through higher prices. This will depend on the nature of demand for the product. If the demand is elastic, the supplier may opt to bear the cost himself and refrain from charging higher prices to recover part of it. The buyer should satisfy himself that burden of trade credit is not unduly loaded on him through disguised price revisions. The following formula can be used for determining the effective rate of return. R, that is annual interest rate for the use of funds, equal to C, cash discount for the period, and the year will be taken as 360. And D, number of extra days the customer has use of supplier's fund. Let us take an example. Same type of calculation, the same is here. This we have already discussed before. If a firm wants to hold additional inventory but does not have the cash to finance it, if the credit term is 2% discount for payment within 10 days with 60 days credit period and the bank rate is 9%, should the firm take the discount? If the discount is not taken by the 10th day, the effective rate of interest on the funds held and utilized for the remaining 50 days will be 14.7%. We have already calculated it. And the bank rate is 9% only. Therefore, it is advisable to take the discount offer even if it involves utilizing bank borrowing for effecting early payment for availing the cash discount. Or you may say it is better for the person to take loan from the bank at 9% and make the payment and avail the cash discount. Advantage of payables. Easy to obtain. No problem. It may be informal as well, so long as the person obtaining advantage is ready to make the payments on time. Suppliers assume the risk. Sometimes it also happens that if the goods is not sold in the market, the buyer asks the seller or the supplier to take back the goods. Informality. The payables are informal type of credit and continuous financing. One payment is made and at the same time another supply is received. Means this credit continues forever. Effective management of payables. The salient points to be noted on effective management of payables are: negotiate and obtain the most favorable credit terms consistent with the prevailing commercial practice pertaining to the concerned product line. Where cash discount is offered for prompt payment, take advantage of the offer and derive the savings therefrom. Where cash discount is not provided, settle the payable on its date of maturity and not earlier, because there is no advantage. Do not stretch payables beyond due date, except in inescapable situations, because you have the chances that you may not get trade credit in future. Sustain healthy financial status and a good track record of past dealings with the supplier so that it would maintain his confidence. In highly competitive situations, suppliers may be willing to stretch credit limits and periods. Assess your bargaining strength and get the best possible deal. Avoid the tendency to divert payables. Maintain the self-liquidating character of payables. And do not use the funds obtained therefrom for acquiring fixed assets. Provide full information to suppliers and concerned credit agencies to facilitate a frank and fair assessment of financial status and associated problems. Keep a constant check on incidents of delinquency. Once overdue payables are given priority of attention for payment, the delinquency rate can be minimized or eliminated altogether. Managers shall not think that payables management is a back office function. In view of the competing uses for materials, advancement in the technology, and the growing significance of supply chain management, SCM, this function also needs to be viewed as priority. Coordination between the purchase department and accounts department is very much necessary. In the light of the NEFT and RTGS practices becoming widespread and moving towards paperless processing, the issue shall be not about delaying the payments, but it is about effective scheduling of purchase orders and payment. Finally, it is the command of the company on the data flow about suppliers, shortage, market trends that would greatly contribute in designing newer and innovative ways in the management of payables. Now, bank credit. Bank credit constitutes one of the major sources of working capital for trade and industry. With the growth of banking institutions and the phenomenal rise in their deposit resources, their importance as the suppliers of working capital has significantly increased. Principles of bank lending. While granting loans and advances, commercial banks follow the three cardinal principles of lending. The first principle is principle of safety. The most important principle of lending is to ensure the safety of funds lent. It means that the borrower repays the amount of the loan with interest as per the loan contract. The ability to repay the loan depends upon the borrower's capacity to pay as well as his willingness to repay. To ensure the former, the banker depends upon his tangible assets. Means if the borrower has got tangible assets and has given as collateral to the bank, it is borrower's capacity to pay and the viability of his business to earn profits. Borrower's willingness to pay depends upon his honesty and character. Or in short, you may say, principles of safety depends on collateral as well as character. Principles of liquidity. Bank mobilize funds through deposits which are repayable on demand or over short to medium periods. The banker therefore lends his funds for short period and for working capital purposes. Principles of profitability. Banks are profit-earning institutions. They lend their funds to earn income out of which they pay interest to depositor, incur operational expenses, and earn profit for distribution to owners. However, they do not have to sacrifice safety or liquidity for the sake of higher profitability. Or you may say that first two principle of safety and principle of liquidity, are more important to the banks as compared to the principle of profitability. Style of credit. Commercial banks provide finance for working capital purposes through a variety of methods. The main system or style of credit prevalent in India are depicted in the following diagram. Bank credit, two types: loans and advances and discounting of bills. Loans and advances are of three types: overdraft, cash credit, and loans. Loans further are divided in short-term loans, personal loans, medium and long-term loans, bridge loans, composite loans, and others, which includes credit card, educational loans, housing loans, etc. These educational loans, housing loan, credit card may also come to the category personal loans. Now we are discussing all these type of credit. First of all, overdrafts. This facility is allowed to the current account holders for a short period. Under this facility, the current account holder is permitted by the banker to draw from his account more than what stands to his credit. The excess amount drawn by him is deemed as an advance taken from the bank. Interest on the exact amount overdrawn by the account holder is charged for the period of actual utilization. The banker may grant such an advance either on the basis of collateral or on the personal security of the buyer. If the buyer has got the highest order of integrity. The important thing in the overdraft is the interest is charged only for the period of actual utilization of overdraft facility. Cash credit system accounts for the major portion of bank credit in India. The salient features of this system are as follows. Under this system, the banker prescribes a limit called the cash credit limit, up to which the customer borrower is permitted to borrow against the security of tangible assets or guarantees. The banker fixes the cash credit limit after considering various aspects of the working of the borrowing concern, that is, production, sales, inventory levels, past utilization of such limit, payments, etc. The borrower is permitted to withdraw from his cash credit account amount as and when he needs them. Surplus funds with him are allowed to be deposited with the banker anytime. As the borrower withdraws from cash credit account, he is required to provide security of tangible assets. When the borrower repays the borrowed amount in full or in part, security is released to him in the same proportion in which the amount is refunded. The banker charges interest on the actual amount utilized by him and for the actual period of utilization. Though the advance made under cash credit system is repayable on demand and there is no specific date of repayment, in practice the advance is rolled over a period of time. That is, the debit balance is hardly fully wiped out and the loan continues from one period to another. Sometimes even window dressing is made that the payment is received on the last working day of the financial year and again advanced on the first day of the next financial year. Under this system, the banker keeps adequate cash balance to meet the demand of his customers as and when it arises. But interest is charged on the actual amount of loan availed of. Thus, to neutralize the loss caused to the banker, the latter imposes a commitment charge at a normal rate of 1% or so on the unutilized portion of cash credit limit. Third is the loan. Under the loan system, a definite amount is lent at a time for a specific period and a definite purpose. It is done by the borrower once an interest is payable for the entire period for which it is granted. The different types of loan we shall discuss in the next counseling session. Thank you. That's all. Namaskar.